Welcome to the 1515, brought to you by the regulatory legal experts at the Maples Group. Here, you will learn more about the latest developments in the regulatory laws of the Cayman Islands on the 15th day of every month.
Good morning, everyone, and welcome to the 1515 podcast. My name is Chris Capewell. I'm a partner and global head of the regulatory and financial services team here at Maples in Calder. Joining me today is my fellow partner and the mainstay on 1515, Tim Dawson. Also joining Tim and I today is Senior Associate Anthony Mourginos, preferred to be known as Donny. In this May edition, we're going to discuss all of the latest developments in the regulatory laws that have happened since our last podcast, which was in April. The topics that we are going to cover today are going to include beneficial ownership. There's been some recently released guidance and regulations on that. We'll then discuss some amendments that have come through to the AML regulations. We'll then talk about the SAR regime and an update on that. And then finally, I'll give a short update on some CRS. Please note the contents of this podcast do not constitute legal advice and they do need to be taken as a general update only. Before we get starting, just a quick reminder that if you are listening from your usual podcast app, you'll find any resource documents and speaker information in the description. If you've clicked on the media player sent to you via email, you can find this information in the notes section. If you'd like to hear those updates every month, please don't forget to subscribe to us on Apple Podcasts, Spotify, or Google Podcast. Tim and Donny, the focus of this podcast is going to be around beneficial ownership, particularly the recently released drafts of the guidance and the regulations. So can I hand it over to you guys so that you can track us through and also discuss some of the sort of more relevant issues that you may have seen?
Yeah, thanks, Chris. So that's right. On the 30th of April, the Ministry of Financial Services and Commerce released an industry consultation of the updated regulations and a set of guidance notes for the beneficial ownership regime. These regulations and guidance accompany the primary legislation, the Beneficial Ownership Transparency Act, and do provide some useful insight on some of the trickier aspects of the regime, some of the aspects which industry we're hoping on clarification from the ministry. The draft regulations do largely, in a lot of ways, repeat the regulations which exist under the current regime, with a few obvious tweaks to account for the new legislation. Just a few points to draw out for the purposes of this podcast that come from a review of the guidance and the regulations. The first point for me is how the guidance notes treat the analysis of identifying beneficial owners and reportable legal entities. Relevantly, in the guidance, it suggests that the analysis of identifying reportable legal entities is slightly narrower than I think industry were initially expecting, or at least we were initially expecting looking at the primary legislation. Relevantly, the guidance seems to suggest that the analysis would effectively stop once you identify the first reportable legal entity, or RLE, in the chain of ownership of the entity in which you are conducting the analysis. If that holds true, and it's certainly something that our consultation response will address, and hopefully the ministry will clarify, that is certainly a welcome point coming out of the guidance notes in particular. It would certainly simplify some of the analysis that would need to be done in the context of investment funds, which, as our audience will know, once the regime does come into play, in particular in the context of the investment fund industry, where, as our listeners will know, investment funds are able to take advantage of the alternative route to compliance. However, subsidiaries of Cayman Islands investment funds are not. So, in theory, fully in scope and having to establish and maintain a beneficial ownership register. If the analysis regarding reportable legal entities holds true, then you would effectively stop once you identify the first reportable legal entity, which in some cases may be the fund itself, which sits above the subsidiary. So certainly a welcome change and hopefully a little bit more clarity coming out of the consultation on that point. Tim, was there anything else that you wanted to raise on the consultation?
It would make sense if this is the approach. If you do stop at the first direct RLE in any given chain of ownership, then that's great. It's consistent with the approach in FATCA and CRS. We have a reportable financial institution directly in the chain of ownership. And so we'll wait and see if that is indeed the case. And as you say, it would mean that the alternative route to compliance for funds would make an awful lot more sense. A couple of other aspects which are interesting, and again, all of this is still somewhat up in the air, but at least being raised in the consultation drafts. The first is the definition of the senior managing official. Now, to give you some broader background on this, in the quote-unquote old days under the FATF rules, when you went to the categories of beneficial owner and down the waterfall of who a beneficial owner would be, the last level in the waterfall, the last category was the quote-unquote senior managing official. What the FATF did last year in newly released guidance is say when you can't identify a beneficial owner, then you need to nominate a senior managing official. So you're effectively distinguishing between a beneficial owner on the one hand, i.e. someone with some sort of interest in the ordinary sense of the word in the entity, as opposed to a senior managing official who's going to be more of a contact person. That being the case, then we'd hope that there's going to be expanded leeway with respect to who a senior managing official may be, or who a kind of correct nominee would be. I mean, if you think about it in the investment fund context, the vehicles are often set up by an investment manager in, for instance, the United States, and there'll be someone there who's actually in de facto control of that vehicle in a broader fund structure. But anyway, that's an item on which we've kind of fed back some thoughts, and we'll see how that plays out. Not dissimilarly, the beneficial owner definition excludes quote-unquote professional advisors and quote-unquote professional managers. And now in the context of what I was just saying before about the purpose of the beneficial ownership regime, which is to capture individuals who have an actual vested interest in a given entity, one would have thought that this would mean that you'd be carved out if you're involved in the control of an entity purely as an employee on a professional basis. So again, these are some thoughts we fed back to the government, and we'll see how that gets reflected in due course. Dolly, any thoughts on the authorised contact issue?
Yeah, there is a little bit of a need for some additional clarity on the authorised contact point. So just for background on that, as our listeners will again be aware, in the context of investment funds who are taking advantage of the alternative route to compliance, the obligation on those funds is to effectively nominate, if they are applying the alternative route, to nominate a authorized contact person to be listed and disclosed to the registrar on a regular basis. The authorized contact can be one of two types of legal entity. It can be a fund administrator who is licensed in the Cayman Islands, or any other regulated or licensed Cayman Islands entity. What I think we are hoping for a little bit more guidance on is the exact requirements that would apply to those authorized contacts that are disclosed to the registrar. Now, just by way of a reminder, the role, at least on the face of the legislation of the authorized contact, is to be just that, the authorized contact. So if the registrar were to be testing the identification of beneficial owners and reportable legal entities behind an investment fund, which is applying the alternative route, the idea is that they would reach out to that authorized contact, and the authorized contact then has a period of time. In the legislation, it says 24 hours to provide the quote-unquote beneficial ownership information to the registrar. What is yet to be kind of crystallized and clear, at least in my mind, on a review of the regulations and the guidance and the primary legislation, is what are the exact requirements that apply to the authorized contact, or at least what is the extent of the potential liability that may attach to the authorized contact? Is it the case that the authorized contact merely needs to contract the obligation to provide the information with the relevant fund, or if indeed they are not the administrator? What are the potential liability exposures to the authorized contact if they're unable to comply with the timeline requirement given by the registrar, despite best efforts in obtaining the information? Another point is the extent of the obligation on the authorized contact to review or indeed potentially even verify the information. On the face of the legislation, it doesn't appear that would be a requirement, but there are some suggestions in the guidance that may not be the way indeed everyone is looking at it. So hopefully a little bit more clarity coming out of the consultation regulations and guidance. But that's the way I see that point on the authorized contact. Anything further from you on that, Tim?
I think that's covered the main points we've been kind of chewing the pencil over. Yeah, we'll wait and see. I mean, it does look as if the regime is going to come into force, the new regime, or rather beneficial ownership registers will need to be available at the start of next year. So I imagine the new rules are going to be turned on fairly soon. And we can only hope that we have crystal clear guidance and regulations so that we know how to apply the new regime.
Yeah. And on the commencement point, the other thing which hopefully we have clarity on sooner rather than later is, At the last turn of the consultation phase of the legislation and the regulations, which was in 2022, the suggestion was that certain aspects of the regime would be turned on in a phased approach. I think we are assuming that that phased approach will still be taken on board, but exactly what that looks like and how we get to a, kind of 1 January 2025, if that indeed is going to be the kickoff date for when registers need to be available, how that phased approach may be implemented is still a little bit of an unknown.
Thank you both. The only point reminding listeners on this one is that all of this has been drafted in the context of the FATF and particularly Recommendation 24. So to the extent some of this doesn't get accepted by industry, some of the feedback doesn't get inputted, there is a framework there that we do need to adhere to, and there'll be some advantages there. Donnie, you mentioned sort of crystal clear guidance, or perhaps it was you, Tim, but we do have Recommendation 24 and the interpretive notes there that may help with some of the queries. But yeah, definitely good points. There's a lot of industry associations at the moment poring over the regulations and the guidance. So let's see where we end up on this one. All right, Tim, moving away from BOR, if we can just get a quick update on some of the amendments to the AML regulations. And then I think you also just want to talk about SAR regime update.
Yeah, again, all linked to kind of FATF requirements and making sure that our regulations reflect those. The anti-money laundering regulations were amended on 19th of April by way of amendment regulations from last year being turned on. The bulk of the changes are really kind of somewhat optical because they're making it clear that compliance requirements apply not only in the context of anti-money laundering, but also in the application of counter-terrorist and counter-proliferation financing measures. And so, for instance, when they're discussing the need to kind of carry out enhanced due diligence in the context of proliferation financing, that there is some additional wording, including the requirement to carry out sanctions checks where there are higher risks of proliferation financing. So it's not really changing much of what is done in practice, but there is that emphasis on those regimes. There has been a change to the customer due diligence threshold, except it's not really a change. Previously, there'd been a change to legislation to lower the standard at which you have to kind of carry out kind of KYC checks for AML purposes to 10,000 CI dollars, which is in line with US dollar equivalent or euro equivalent internationally, but there were still a couple of rogue references to $15,000, which was the previous threshold, which are now being removed. There's some tweaks to the way that risk assessment is dealt with. Now, risk assessments, I would say, we'll take the opportunity to say, are a key part of SEMA inspections. So regardless of the actual changes in practice, somewhat small, the need to have risk assessments and update them from time to time is something that all of our regulated entities ought to be doing and have that papered with a view to one day being inspected by SEMA. There is some new wording that risk mitigation controls need to be consistent with national requirements and regulator guidance. Now, it's always been the case, or it's always been understood that under the administrative fines regime that directors and officers could be fined. Well, the actual AMLRs wording on this aspect was a bit unclear. That's now been changed. So if SEMA were minded to levy fines against individuals for breaches of the AMLRs, the wording for that is now contained within the regulations. Similarly, directors and officers of DNFPBs could also be in scope for fines. Now, DNFPBs are entities which are not carrying out financial services, but are nonetheless subject to anti-money laundering regulations. So that's things like realtors and jewelers and even law firms. DNFPB stands for Designated Non-Financial Business Professional. They've also got new requirements to provide information with respect to who their AML officers are and who their beneficial owners are, and also provide updates of their risk assessments, in each case to their regulators. So those are the changes that were made to the AMLRs. Another change in the realm of money laundering legislation is that while in October 2023, the Amendment Act was passed amending the Proceeds of Crime Act, certain provisions dealing with SAR filings will now only be turned on at the start of next year. Now, what these changes introduced are a requirement to not only make a disclosure to the Financial Reporting Authority or the FRA where there's a suspicion of crime, but to have to consent of the FRA prior to committing certain acts. Specifically, if you are a Cayman bank and you're a bit worried that you've got money which could be the proceeds of crime, whereas previously you would basically file a SAR and that would be the end of your obligations. In the future, you're going to need to get positive consent from the FRA before making an onward payment. So there's been a delay in the implementation of this regime. What seems to be the case is that the FRA are still working out the details and logistics of implementing this new consent regime, and we expect that in due course we'll receive guidance with respect to how this aspect will work in practice, including timeframes for granting or refusing consent.
Thanks, Tim. That was comprehensive both on the AML and the SAR. Just to close this off, there has been some updates on CRS. So it was 12th of April, Tax Information Authority did release a gazette that changed some of the participating and reportable jurisdiction lists. So there's a lot of different countries in there, for example, Georgia, Gibraltar, Kazakhstan, Liberia, Moldova, Montenegro, Morocco, Qatar, Uganda, Ukraine, Kenya. So have a look through that gazette, see how that impacts your existing reporting obligations. Just a reminder, I guess, if an entity is resident in a non-participating jurisdiction, the primary one that we do have currently is the US, then the rules of the participating jurisdiction in which the account is maintained, such as here in the Cayman Islands, will determine the entity's status as an FI or an NFE. Also, just a reminder that the definition of passive NFE under CRS would require you to drill through any LIMB investment entity located in a non-participating jurisdiction. So to the extent you do have any account holders in the jurisdictions I mentioned that are now non-participating, you may need to do a drill through and treat them as if they're a passive NFE and therefore look for the controlling person. One other point just on CRS as a result of this, and it's an ongoing obligation, but just a review of your existing written policies and procedures to ensure they're up to date and that they track the latest countries, both participating and reportable. One other point before we do close, just an observation that we're seeing here at Maples is that CIMA seems to have commenced a new round of inspections of CIBA registered persons. What we're seeing is that you'll normally get a notification letter, questionnaire and a document request, and then there is a deadline which you need to respond to, which is typically around about 2 weeks. So if you do have any CIBA registered persons, just be mindful that there's another round of inspections. All right, thank you very much everyone for listening in. As always, thank you Tim and thank you Donnie for spending the time, much appreciated, and we look forward to speaking to you on our next podcast.